Hey, welcome to Everyday Economics, a podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit Franklin Muse Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our great podcasts at americastalking.com. To support Everyday Economics and podcasts such as this one, please make your tax-deductible charitable contribution by clicking the link in the show description. We're recording this episode on Friday, February 17th, and joining me as always, my friend, colleague, and someone who just tells it like it is. Dr. Orphe Divounguy is a PhD economist. Hey, Dr. O, we got some mixed signals in the market. It really did a number on my portfolio yesterday. Like I said, we're taping this on Friday, February 17th. I sat there and just watched my brokerage account just like sort of melt, like an ice cube in the sun. CPI numbers came out on Valentine's Day, and we've got a new retail sales report that's out. And you think that these two things are conspiring to ruin my brokerage account?
Yeah, we got some surprises. I mean, CPI inched up in January, slightly more than expected, meaning year over year, annual increases in CPI ended up roughly where they were in December, meaning that inflation is not slowing as fast as everybody had expected. We also had those revisions from last year, end of quarter four, upward revisions. And on top of that, we just had a retail sales report that also shows retail was pretty strong in January. And so all of this is leading a lot of observers to worry that the decline in inflation might have stalled. And if that's the case, that the Fed will likely respond by raising rates, maybe not even just 25 basis points, but even more, right? It might even go to 50 basis points this time around to try to really, really get this whole inflation thing under control. There's a lot of fear that without the Fed firmly on the economic brake pedal, higher inflation could come roaring back just like it did in the 1970s. And I think with the lessons of the 1970s firmly in mind, the Fed could opt for tighter policy for much longer. And of course, that's going to squeeze households further.
Let's talk about this a little bit. So Jim Bullard from the St. Louis Fed, I believe it was Cleveland Fed President Loretta Mester. It's from a story that I saw at Market Watch yesterday, late in the afternoon. They're saying that they need to get to 50. We need to get to 50 basis points minimum, maybe 75 basis point increase as soon as we can. That the 25 basis point increase that the Fed approved in its last meeting, which was only 2.5 weeks ago, didn't hit the target.
I don't know. I worry that, with too high inflation, of course, we know is could cause the plane to run out of fuel and crash. But at the same time, I'm worried that consumers are already on the brink. If you look at households' debt service as a share of disposable income, it's increased tremendously in the last 6 months. It was super low, right? Households had gotten a lot of savings, paid down some debt. And now with high inflation and high interest rates, consumers are have dug into their savings and are digging into those credit allowances. They're digging into those credit cards. I saw a recent report from TransUnion saying, look, in quarter four of 2022, credit card balances increased by 19%. And if you think about, right, because the Fed is firmly focused on the labor market and saying, look, wage growth is too high. Wage growth could be driving inflation and preventing inflation from coming down. Well, look, the 6% wage growth is just not enough to keep up and deal with credit card balances rising by 19% in one quarter. And I think that we're in a situation where the consumer is so tight. The consumer is kind of used to the spending, the pandemic kind of lifestyle, bringing that spending back down into control. I don't know how much consumer behavior is finally changing.
I think I'm looking at it the same way that you are. And I mean, obviously you're an economist, you're looking at the data. I'm a journalist. And I mean, I just spend most of my time talking to people, trying to get a pulse for what's going on. I think there are some people that have not hit the brakes on their own spending just yet, or maybe perhaps made some financial obligations that were a little aggressive that they're trying to meet. And with prices increasing around them, sort of being swelled under by the decisions, not that they're making now, but the decisions that they made last year. I saw that, and this is one thing, it's just conversationally, right? The average price of a new car purchase last year was just under $50,000. And I mean, you're talking about a norm now where people are carrying $750,000, $850,000 car payments is norm. It's like normal now. That's a huge amount of money.
And we know that banks extended a ton of credit during the pandemic, right? Interest rates are super low. And so now households are their financial condition is back to where it was before the pandemic. And so the question is, how long before they run out of fuel? When you have 6.4% consumer price increases year over year. Hopefully that's going to continue to come down, right? Because I'm still very optimistic that disinflation is very much underway. But I think it's worrying because, I saw Goldman Sachs just revised their forecast. It's not saying, hey, the Fed might go with 3 more 25 basis point hikes. Goldman is concerned in the PCE price index, which is the Fed's favorite inflation measure, which comes out next week, is saying, look, it might be up 4.5% year over year compared to 4.4% year over year in December. That is concerning to me because, if the Fed continues to raise interest rates, which I think would be the right call, if of course, that's if the data really reflect the picture on inflation, the true real picture on inflation. So if the Fed goes that route, right, interest rates continue to increase, it should bring inflation under control. But at the same time, we have, right, these credit card increases that are going to come back to bite households. I think households are squeezed between the high price environment and the high interest rate environment. And of course, we also see LinkedIn data saying the labor market's poised to come down, to cool down. And so you have the conditions here for a lot of trouble for households. A labor market that's going to slow down, very high interest rates, and interest on debt continuing to pile on, and prices that are resisting, right? There's a lot of resistance on the price side. And, when I think about all of these conditions, I worry a lot about this inflation picture. Now, the positive news here is that we know shelter is definitely coming down. Rent in CPI is coming down. The Zillow Observed Rent Index leads the rent components in CPI. We know rent is coming down. So that's gonna pull down inflation. Now, the question is, all the other factors that are keeping prices high also going to come down. Is it just demand? If it's just demand, then the Fed interest rate hikes should do the job. We'll see.
I appreciate the insights as always. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.